Good evening to all of you. Welcome to our class. So we pick, the last time we were discussing on how we manage, we were discussing on the financial institutions and the financial market, okay, the financial institutions and the financial market. So today, I want us, if I'm not wrong, I think that's what we were discussing. Okay, the last image. We were discussing on financial institutions and financial market. And if I remember, we did complete on that topic, on the financial institution and financial market. Daniel. Daniel? Daniel? Daniel, you came to class and you left. Robert?
Yes.
Yes, that's what we discussed last time. Financial institution and financial markets.
Yes, I think so, yes.
We went all the way to discuss the different instruments that can be issued in the money market. Do you remember the repurchase agreement, the certificate of deposit? You remember all this?
Yes.
Okay, fair enough. Okay. Then if all of you do remember that, then I think we can proceed to our next topic then. Okay. Thank you, Daniel. Robert, that is.
Okay.
Now, so today I want us to start with this topic, okay, one of the major topic, okay. For those who are there in the first class, I told that working capital, okay, is one of the major topic, okay, that the examiner, of course, will be testing you, okay. So most likely you have a question, okay, that will be coming from working capital, okay. So get to understand the concepts that we shall be discussing in this particular topic, okay. Most likely there will be a question, okay, by your examiner, okay. Anyway, now what's working capital, okay? Now working capital, okay, essentially from accounting perspective, we do see that it is the excess of current assets over current liabilities of a firm, okay? That the net working capital, okay, is the excess of current assets over current liabilities, okay? The excess, yes, Claire.
Good evening, sir. We hadn't finished the last topic.
We hadn't finished. We didn't finish.
No, we just did the 3 slides. Then we were to start on capital markets and money markets.
Oh, we did it. Wow. Okay.
Yeah, actually,
okay. Thank you. Okay. Thank you. Okay. Then you can have a simple. Let's go through that topic then, in case we didn't finish. Where's Joseph?
Yes, sir.
Yes,
sir.
So we didn't finish on that topic.
Oh, yeah, we didn't.
Okay. Wow. Okay. I thought we had. Anyway. Okay. Then let's just go through. Give me a minute. I need to open this one. Okay. Fair enough. Let's go through that topic then. Okay, so just check on you, Joseph. Joseph,
Yes, sir.
had we gone through the slide that this slide, the money market, capital market? Had you gone through it?
Okay, I don't remember. I don't remember seeing this
Oh,
in our class.
no, last class we did discuss on the role of finance intermediary.
We discussed the roles. We did the financial intermediaries and the roles. That's where we ended.
Oh, that's where we ended the class.
Yes.
Okay. Thank you. So the last time that we met, we did discuss on the functions, okay, of the laws that the financial institutions and the financial intermediate they do play in the economy. Okay, we can further classify the financial market. Okay, we can classify the financial market in what we refer to as the capital markets and the money markets. Okay, the capital markets and the money market. Now, what the distinction? Okay. The distinction, if you remember that graphic, okay, that pictorial that you had between the surplus units, the deficit unit, we had the banks in between. We say that if you're going, in the case of the financial market, we are going to, if you're going to be the surplus unit, if you are the surplus unit, that is those individuals, those maybe even funds, maybe, okay, that have excess funds than all they need, then you can opt to invest in the deficit unit company, in the deficit unit, okay? In exchange, you're going to be receiving a contract, you're going to be receiving a security, okay? You're going to be receiving what we call a financial asset, okay? That details, okay, the promise that the issuer, the company wanting to borrow money, okay, promises, for example, to pay you. If, for example, it is a bond, okay, for example, the contract you have, okay, in this case, it is a loan note, okay, it's a bond, okay, that the company wants to issue. Then, of course, the company is promising, give me, for example, 100,000 cash shilling, okay, and I'll be paying you maybe every year, okay, 10% of the amount you give me, okay. So the company has a promise. The company is giving you a promise that every year I'll be paying you X amount of money. In the financial market, we can classify the financial market into based on what security, based on what financial instrument, what financial asset has been used in obtaining the money. Okay. Now, if the financial asset, okay, the financial instrument, that security, okay, for example, the case of bonds, the bills, okay, the treasury bills that are issued by government, for example, the treasury bonds. Now, if the financial instrument, the financial asset that has been used to obtain the money from the surplus unit, okay, has a life that exceeds one financial year, okay, it has a life that exceeds one financial year. In short, therefore, if it's a debt instrument, and the issuer, the company wanting to borrow money, okay, is promising to pay you interest every year for the next 10 years, for example, okay, then we do say that the transaction is occurring in the capital markets. We say the transaction is occurring in the capital market, okay. So the key distinction, okay, so the key distinction between the capital market and the money market is simply what is the nature of the financial instrument that is being used to obtain the capital. If the financial instrument, if the security, okay, that contract in quotes, okay, that the surplus unit has been given in exchange for the money, in exchange for the capital, okay, if the life of that instrument is going to be more than one financial year, then we say the transaction is occurring in the capital market section of the financial market. If that financial instrument has a life of maximum life of 1 year, okay, its life is a maximum period of 1 year, then we say the transaction is occurring in the money market section of the capital market. Okay, the key distinction between those two, the capital market and the money market. Okay, so we simply go back to the financial market. Okay, where let me just attempt to draw that graphic we had. Okay, so you see that if you remember the same way we had here the surplus units. Okay, we have the surplus unit, and here we have the deficit unit. Surplus unit is going to give money, okay, to the deficit unit. So this is the flow of funds or capital. And of course, in exchange, the deficit is going to give a promise, okay. We are going to have a contract here, okay, that details the terms and conditions of the agreement, okay. And this is what we are calling as the financial instrument, okay, or the security. or the financial asset. Okay, they're all the same, or the financial asset. Okay, so I said the key distinction between the money market. Okay, we can say that we can subdivide financial market. Financial market. Give me 1 second. So you see that we can classify financial market in two main categories. We have here the capital market. Here the capital markets, and you have here the money market, capital market, and you have the money market. And so the key distinction is simply what is the instrument, this financial asset, this security, this contract, okay, what is its maturity, okay, what's the life of that contract, okay? If it is going to have a life of more than one financial year, okay, more than one financial year, then we say the transaction is occurring in the capital market section of the financial market, okay? If the life or the maturity of the instrument that has been used to obtain capital from the surplus units, okay, has a maximum life, okay, it has a maximum life of one financial year, okay, equal to or less than 1 year, okay, then it's a transaction is occurring in the money market section of the financial market, okay. That's a key distinction between the capital market and the money market, okay. So what's the life of the instrument? What's the life of the asset that has been used in acquiring, in getting finances, okay? What's the life of that contract? What's the maturity, okay? That's the key distinction between the capital market and the money market, okay? Capital market and money market. Actually, we can extend, okay, include the definition of the money market to also include, okay, what referred to as the short-term lending and borrowings, okay, short-term lending and borrowings in the market, okay. You're going to have lending of, also in the case of financial institution coming in here, okay, so the money market also does come in here. The short-term lending and borrowings also do occur in the money market section of the financial market, okay. And there's a key distinction between those two, the money market and the financial, the money market and the capital market. Hope it's really clear, okay? Hope it's clear to all of you. If not, don't forget, you can always let me know, okay? This is the money market. This is a market for trading of the short-term, short-term lending as well as borrowings, okay, in the market, as well as the trading of the short-term financial instrument, okay, the so-called the money market instrument, okay, those instruments, those financial assets, those securities whose life has a maximum life of one financial year, okay, then the transaction occurs in what referred to as the money market section of the capital market, okay. So, of course, generally, they're going to be operated by banks. So, the main participant, okay, they're going to be the large bank and the financial institutions, okay. So, of course, you as individual, if, for example, you want to buy, for example, bills issued by the government, okay, of course, the easiest way for you to do so, instead of going through the broker, for example, okay, of course, the best way is to go through the bank, okay. If, for example, you don't want to buy the T-bills, okay, the treasury bills the government is issuing, okay. So the easiest way for sure is to go through the banks. Okay, so in most cases, they are the banks or the financial institutions that do facilitate this process. Okay. Now, some of the instruments, okay, that can be issued here, some of the securities that can happen, or that the transaction can happen in the money market section. Okay, of course, the T-bills, okay, issued by the government. We have the commercial paper. Now, the difference, by the way, between T-bills and commercial paper. Now, the commercial papers, okay, the T-bills, okay, they are issued by the government, okay. So, for example, in case of through the Ministry of Finance, okay, or through the CBK, okay, they can issue a bill, okay, of course, whose aim is to, for example, take care of the short-term needs of the government, okay. The government want to pay, as an example, to pay the teachers, okay. They don't have the money, so of course, they can just go to the market and issue a bill, okay. Or maybe a bill can also be issued in a case where the government wants to repay another bill that is maturing and doesn't have money, okay. So of course, it's sort of a rolling over, okay. So we want to pay for a bill that is already maturing. So we issue another bill to pay off, to refinance, okay, the bill that's already maturing, okay. Now, in case a similar security is issued by a commercial company, okay, there is not referred to as a bill, okay, it's referred to as a commercial paper, okay, it's referred to as a commercial paper, okay. So in case it is issued by a corporate, it's issued not by the government, but is issued by a corporate, by a company, okay, then it is referred to as a commercial paper, okay. By the way, what's the life of treasury bills, okay? The bills that are normally issued by the government of Kenya, for example, what's its life? Their life does not exceed 1 year, okay? That it doesn't go beyond 1 year, in short. But generally, yes, Sharon.
Okay, I think the T-bills, mostly you can trade for 3 or 6 months, depending. So it's either 6 or 1 year, 6 months or 1 year.
6 months or 1 year.
Yeah.
Generally, the life of bills that is normally issued by the government, okay, I agree with it to some extent, okay, they are 91 days, okay, so generally the life of bills is 91 days, okay, 2 days, okay, this will have 182 days, okay, and you have 364 days, okay, so 91 days, maybe 3 months, okay, roughly, okay, then you have, here to be 9 months, this is 6 months, and this is more or less like 1 year. Okay, so they have a life of 91, 1 is 2 days, 2 days, 364 days. Okay, so those are the general life of the bills that can be issued. Okay, so they don't go beyond 1 financial year. So the maximum life for bills, case of Kenya, is the 364 days. Okay, conventionally, in case they're issued by a commercial company, in this case, the commercial papers. Okay, then their life is going to be mostly going to be 91 days. Okay, mostly going to be 91 days. Okay, going to be the 3 months. Okay, or the 91 days. Okay. Now we have the certificate of deposit. By the way, just before I get out of commercial paper, if you have a company who has issued a commercial paper, definitely what you're trying to tell the market that I have an urgent need for money. Okay, now, okay, I'm going to pay you in 3 months. In 3 months' time, by default, for you to be able to issue, for you to be able to give that promise to the market, then you must be a very liquid company. Okay, maybe you just have some short-term needs for money, but you're very sure input. Okay, you are certain in 3 months' time you have the money to pay off. Okay, that commercial paper as it matures. Okay, so definitely it is going to be issued by let's say a company that are very liquid. Okay, so not going to be issued by any of the companies. So those companies that are deemed to be quite liquid, okay, then generally they can go to issue commercial papers because you're going to issue a bill, okay. In 3 months' time, you must pay back that money, okay. Definitely, therefore, you must be a very liquid company, okay. Then you have got the certificate of deposit, okay, certificate of deposit. In the case of the certificate of deposit, sometimes called the CD, in case certificate of deposit. Now here, let's say the commercial banks, okay, the commercial bank, okay. So they may tell you that we would want to sell to you, okay. We would want to sell to you, okay, an agreement, okay, where you're going to give us, okay, let's say 10 million, okay. Let's say you're going to give us, not 10, let's say 1 million, okay. So we're going to sell to you, okay, a certificate of deposit of 1 million, okay. This certificate of deposit is going to mature in, let's say, 3 months' time, okay. So it's going to mature in 3 months' time. Now, in 3 months' time, let me call it time 3, 3 months' time, okay. The bank gives you, or the financial, or the issuer, let me just call the issuer. The issuer gives you a promise. I'm going to give you back, okay. In short, I'm going to repay. I'm going to repay, okay, you back, let's say, at value of, let's say, Kenyan shilling, let's say 1.1 million. In short, what's the contract? What's the issuer, okay, conventionally to be the bank, okay, is telling you that give me 1 million today. In 3 months' time, I'm going to pay you back the amount of money you gave me plus some interest on top. Okay, because I'm going to give you 1.1 million, the 1 million you gave me, plus an interest of 0.1 million. Okay. Now this CD, okay, is a certificate. Okay, so it's a contract, okay, between the two parties. So in case, for example, at the end of the first month, okay, T1, let me go to time 1, okay, you as the person who bought that certificate of deposit from the bank, okay, you feel that I would want my money, okay. Don't forget, you cannot go to the bank, you can't go back to the bank, okay, asking for money before the maturity, before the end of 3 months. So you can say, why don't I just trade on this certificate of deposit, okay. So at the end of month 1, okay, just look for someone else who is willing to buy you out, okay. For example, you can agree, okay, that I'll sell to you, okay, this certificate, okay, for example, for how much cash is, let's say at 1.015, okay. So you as the original purchaser of this CD, okay, you're going to exit the position by getting someone else to buy you out. Okay, so it's upon them now to wait until T3, 3 months later, 2 months later. Okay, because now you sold at month one. It's upon them to wait 2 months later to go to the bank, present the security deposit, and get the 1.1 million. Okay, in short, therefore, these instruments are tradable. Okay, these instruments they're tradable in the open market. Conventionally, I have not seen this operating so much in Kenya. Okay, so you haven't seen it operating so much in Kenya. Okay, but some of developed economies, okay, it does do happen. Okay, but in Kenya, I am yet to meet this type of money market instrument. Okay. And actually, one of the signs about to assess how developed is the financial economy in a country is just to see what are the available instruments that are on offer on the stock market. Okay, so right now I think they're trying to in the NSC as well as through CME. Okay, they're trying to develop some instruments that are unavailable before. Okay. We shall mention them later on. We have, for example, the forward, the futures. Okay, so I think they're most sure they're still tradable. Okay, but anyway, it's a sign that the market is trying to develop. Okay, by offering different and diverse financial instruments. Okay. Anyway, so those are some of the money market instruments that are on offer. Now, there's another one, just I can make a comment on, it's called a repurchase agreement. Okay, it's called a repurchase agreement. Make a comment on that. Okay, and money market instrument is called repurchase agreement. In the case of also called the repo. In the case of repurchase agreement, let me explain. Let me get my board. Let me just explain through the board. In the case of repurchase agreements, you can have here a company, okay, a firm that intends to sell, okay, or even a bank. I mean, the money, the transaction, okay, they don't need to occur at the floor of the exchange, okay. Anyway, so you can have here a bank, for example, who wanted to sell. So let's call this a bank A. Okay, they intend to sell a bond, so they have made an investment. Okay, they have bought an investment in bonds. Okay, in bonds, they sell the bond, for example, at a value of, let's say, that's $1 million. Okay, or $1 million shilling. Okay, so in T-Note, that is today. In T-Note today, they make a sale of this bond. Okay, for 1 million. Okay, so they make a sale of this bond for $1 million. Okay. Now, that's a sale the sale has concluded. However, okay, a reverse contract occurs, okay, that the bank A is going to purchase the same bond, let's say in 3 months' time. So in T3, there will be a repurchase. So this bank enters to agreement. I'm going to repurchase back this bond, okay, for a predetermined price. So we agreed in T-Note, okay. So you agree, for example, I will buy back this bond for, let's say, 1.1 million, okay, in 3 months' time, okay. So first, there was a sale that occurred here. Then there's an agreement to repurchase back that particular asset, okay. As you can see where the term is coming from, is a repurchase agreement, is a contract, okay, that I'm going to make a sale to you, okay, of this particular asset for this particular price. However, in some future dates, okay, not exceed 1 year, I'm going to buy back the same asset at a price higher than what I sold it the asset for, okay. So it's a repurchase agreement. Now, you can see the person who did make the sale, okay, let's say this bank A here, they made a sale for 1 million, they pay back 1.1 million. So you can see the difference between the selling price and the repurchase price, in this context, the 0.1 million, okay, can be the return the buyer, in this case, bank B, is making for the transaction, okay. So the 0.1 million, the difference here, 1 million and the 1.1 million. So this is the return that bank B is making the buyer, the one who bought this particular asset in T-Note, in time zero, in today, okay. Referred to as a repurchase agreement. Okay. Now that's the substance of the contract. Okay, that's the substance. That's the form. Okay, Candy, you can ask the question before I ask mine.
Okay, let me ask. Let me try to understand. You said bank A is the one. It's investing in bonds, right?
Bank
and recently, Sorry?
Bank A already it has the bond. So they already they bought the bond, for example. Let me just clarify. This bond was bought in 2018. Okay, and today, T-Note, we are in July 2020. So the bond was bought in 2018. So the bank already has the bond with them. Okay.
Okay.
Continue.
So it's like invest bonds.
It's like
Investing. Bank A is investing in the bonds.
Bank A is investing. No, the Bank A has already invested.
Oh, okay.
Yes, so they bought the bonds in 2018, for example. Okay.
Okay.
But now they want to sell those bonds. Maybe they have some cash needs. Okay, so they have some cash need. So they want to look for someone else to buy those bonds with an agreement to buy them back in future. I hope you can see that logic.
Oh, okay. So Bank A wants to sell the bonds right now, but now they have an intention of buying the same bonds in future.
In the future, yes, they're going to make the sale of the bond today. However, they have an obligation to buy them back in future for a certain price which they agreed today. They agree, for example, in July, you're going to buy back these bonds in October for this particular price. So you agree the price to buy them back in advance.
Okay, so it's not like it's trading with different banks. So it's the same bank that is agreeing to buy. It's selling, but it will buy again.
Yes, but you need to have the counterparty. You need to have someone else who's going to buy from you.
Okay, my confusion was where you written Bank A and Bank B. So I thought Bank B is a different bank that is requesting to purchase the bond.
No, okay. Let's say do a simple example. Let me remove the word term bond here so that we use the conventional term, the conventional assets. Okay. Now assume that this bank A, let's not even use a bank so that we can maybe easier to understand. So you have two parties here. You have part A and you have part B. Okay. Now part A owns a motor vehicle. Let's use a motor vehicle. Okay. So part A owns a motor vehicle. Okay. The motor vehicle they bought in the year 2018. Okay. The current value of the motor vehicle, okay, for example, is 1 million. Okay. So the current value of this motor vehicle is 1 million. Okay.
Mm-hmm.
So the bank, so part A or company A or individual A, okay, sells that motor vehicle to a counterparty. In this case, this other party is B. So they sell the asset, the motor vehicle, to party B. Okay, so there's actual legal transfer of the asset from A to B.
Okay.
You get it? And that's occurring today. Okay, so occurring in T-Note. Okay, today, T-Note here. Okay, so the transaction occurring in July of 2020.
Okay.
Now, sorry to use the term bank. So, party A, okay, or firm A, okay, is going to enter in an agreement still today upon making the sale. So, the same sale contract has a clause. It has an agreement that party A must buy back the asset from B in 3 months' time, for example.
Okay.
So they're going to purchase back. They're going to repurchase, okay, that motor vehicle in month of October.
Okay.
Okay, so they are going to repurchase the price upon which they're going to repurchase that particular motor vehicle, for example, they agree today. So in July of 2020. Okay, so you agree in advance. You agree today. Okay, not at the month of October. You agree today that in 3 months' time, in the month of October, I'm going to buy back this motor vehicle for this particular price.
Okay, I get.
Now, part B, okay, what's happening is that they're going to buy back that asset, okay, for a price higher. In this case, for example, they're going to buy, for example, at 1.1 million, okay. But part A bought those assets for 1 million. So therefore, you can say therefore the return to part A for buying that asset, okay, is 0.1 million. The difference in the prices because they're going to get back 1.1 million, but they spent 1 million to buy that asset, okay. So therefore 0.1 million therefore is a sort of a return to party A. Is it clear?
Part B.
To party B.
It's a return to part B.
Yes,
Yeah.
party B. Yes, to party B. Pardon. So it's a return therefore to party B. Okay.
Oh, thank you.
That's called therefore a repurchase agreement that we are going to sell, but we're going to purchase back the asset. Okay, is a repurchase agreement. Immaculate.
Mwalimu, I have a question. How is And beneficial to party A but then?
Now, part A, assume that, for example, you don't have money, okay? And you don't have school fees. Now it's month of January. You have a motor vehicle. You don't have school fees. Are you going to let the kids stay at home?
Okay, I see then. So it's
Yeah.
about getting cash
Yes.
at thank you.
Yeah, so definitely part A has a need for money. So they're going to use one of the assets sort of to get the money. Now, my question was, now what we have described so far is what we call the form. Okay, what we've described so far is a form, okay, is the legal side of it. But of course, don't forget in accounting, we have what we call substance or form, okay. We need to look at what's the economic reality of the particular transaction. Now, what's the economic reality? What you have described so far is a form, okay? There's a sale of motor vehicle, a repurchase back in 3 months' time. That's the form of it. That's the legal side of it, of the transaction, okay? But what's the economic reality of this transaction? You did substance or form concepts. You did that for sure. What is the economic reality of this transaction? A sale is occurring, a repurchase is occurring. Now, all that is a form. But what's the economic reality of this transaction? What's the substance, in short? No one has an idea. No, we can't all lack an idea. We are 22 of us. It doesn't have to be the right answer, don't forget. Okay. And that's one of the reasons why students normally fail the exam. Is that you think you need to have a perfect answer. You don't need to have a perfect answer. And that's why I normally say that do not, in any of the class in the paper, never leave a question unanswered. Okay, that is one of the advice I normally give students. Never leave any question unanswered. Even if you have no idea, try to generate idea. Okay, I'm not sure from which sources you're going to generate, but try to have ideas. Never leave a question unattempted. Okay, that is the advice I always give to people who do professional papers. So don't forget, always attempt a question. Okay, even if you have no idea, try it. I don't know. Try to generate some ideas. It does not have to be perfect. Okay. Joseph.
From my understanding, I think substance means legal ownership.
Substance.
While form means whoever is in possession of the subject.
So that's okay. Now, just whatever you have described, okay, I agree to some extent, but that's the form. That's not the substance. Like who owns the assets? That's the form. You're going to go back to the, for example, in a motor vehicle, you're going to go back to the logbook. Who owns the motor vehicle as per the law of the land? So that's again more of the form. The substance. Let me explain. Okay. Now, what's happening here? What's happening here, okay, is that part A, okay, tell me whether you're going to get this, okay. Part A is just, let me rub off some things here. What's happening here is that part A for sure, it has a better sale, okay. However, why is part A wanting to make the sale? Because they want money, okay. They're going to get 1 million, okay. Then they're going to enter an agreement. We are going to repurchase, okay, this particular asset in 3 months' time, and you're going to be paying 1.1 million. So there we can, in short, we can say the difference in this case of 0.1 million is like what part A is paying for using money that was received from part B. So therefore, the 0.1 million in this context, we can deem it like the interest. And the 1 million that part A obtained, it's a loan. So part A got 1 million loan, okay, from part B. And this loan, okay, is maturing in 3 months' time. The interest attached to it is the 0.1 million. The asset, this motor vehicle, that has been used to acquire this 1 million loan is the security, okay, is the collateral, okay, is what that is being used as the collateral, the security against that loan. That if part B was to fail to pay the money or default, for example, then part B is going to have the motor vehicle as a security, okay. That is simply the substance of the transaction. That part A was using that motor vehicle as a collateral, as a security against a loan they obtained from part B. The part B is going to be receiving 0.1 million in 3 months' time, okay, as an interest for the 1 million that they gave to part A. That's the substance of it. That's the economic reality, okay. So it's only that part A has actually transferred the asset from its book to the they has actually transferred. The reality is that now part B owns that motor vehicle. Before the purchase, part B owns that motor vehicle. However, part A still continues to use that asset. Okay. So even if the sale has occurred, okay, in T-Note today, okay, in T-Note, part A still continues to use that motor vehicle. So in case you go, for example, to the financial statement of part A, they're going to be reporting that motor vehicle as their motor vehicle. Why? Because the substance is over the form. Okay, it's true that B is one who owns that motor vehicle. However, A still continues to enjoy the economic benefits of that motor vehicle. There is no actual physical transfer of assets from A to B. Part A still continues to use that motor vehicle. Part B, okay, is just having in quote the logbook of that motor vehicle, okay, and that motor vehicle is being used as security against the $1 million loan they have given to Part A. Okay, hope that's clear. Okay, that's called a repurchase agreement. Okay, and it's of course definitely it's sort of a money market instrument. Okay. Now, if, for example, part B, okay, they don't want to wait until the 3rd month, okay, 3 months from now, okay, don't forget they can decide to exit the position, okay, they can decide to exit the position by selling the contract in quote to someone else, okay. So, for example, they can decide in the month of September, okay, I don't want to wait until the month of October, okay, I can dispose of this contract, okay, for let's say, for example, for 1.05 or $1 million, okay. Therefore, now part C, the new buyer, is going to be paid by party A. So this particular agreement is also tradable in the stock market. Is also tradable in the market. Okay, so we refer to as a repurchase agreement. Clear? That is another money market instrument. Let me explain another money market instrument called the banker's acceptance. Okay, banker's acceptance is another form of money market instrument. But there, the examiner, new examiner, okay, some of these questions are going to be discussive. Okay, discuss what we mean by capital market instruments. Discuss what we mean by money market instrument. Discuss what we mean by bankers' acceptance. Discuss what we mean by a certificate of deposit. Okay, so there's some calculation here, but the examiner is not going to go to that extent. So it's about trying to getting to know what type of instrument is this. Anyway, so this one is called the banker's acceptance. Let me explain through an example. Okay, I see that you have a Kenyan company here. So you have a Kenyan company, okay, and you have a Chinese company here. So Kenyan company normally import things from Chinese company. Okay, so these are imports, okay, from China to Kenya. Now, if, for example, they want to deal on credit, okay, these two companies, okay, the Chinese company and Chinese company, they want to trade on credit, okay. Assume that they don't know each other, okay? They don't know each other, okay? Therefore, I, as a Chinese company, I'm going to be quite fearful that how can I give you goods on credit and I don't know you, okay? So what they can do, okay, of course, can happen even if we know each other. Like for international trade, it's better that you want to avoid the risk. What they can do is that, as a Chinese company, we're going to ask you, you as a Kenyan company, get an agreement from your bank, okay? Assume that your bank is, let's say, Bank ABC, okay? So get a letter from your bank, okay? And your bank is going to make a commitment. So your bank is going to make a commitment, okay? That in 3 months' time, okay, we are going to pay your Chinese bank, okay? Let me just call this is X Bank, okay? This X Bank is in China, okay? So they're going to set an agreement. They're going to make a commitment, okay? We are the bankers of this Kenyan company, okay? We as ABC Bank, okay? We are going to pay to your bank, you as a Chinese company. In 3 months' time, we are going to pay to your bank, okay? The value of the goods that the Kenyan company bought, okay? We're going, for example, pay you the $1 million that the Kenyan company owes you, okay? So the Kenyan company is entering into a commitment, okay? We are going to pay to your bank in 3 months' time. So that means, therefore, you as a Chinese company, okay, you don't have fear. You don't have the fear that the Kenyan company might default, okay, because it's your bank, okay, you are a Chinese company and the Kenyan company, your bank have made a commitment, okay, your bank as ABC Bank Kenya has made a commitment to pay off your supplier in China, okay, so the bank is making a commitment, okay. Now, what's happening there is that you as a Chinese company, you're going to receive this, in quote, okay, this commitment from your bank in China, okay? So you're going to make a commitment that, hey, the Kenyan supplier, the Kenyan customer you have, okay, we have here an acceptance from their bank, okay, that in 3 months' time, they're going to pay you $1 million. So go ahead and import the goods, and in this case, export the goods to the Kenyan company, okay? Now, you as a Chinese company, okay, you may not want, for example, okay, to wait until month 3, okay, to wait 3 months later, okay. So can go to the market, okay, get someone to buy you off from position, okay, that in 3 months' time, I'm going to get $1 million, okay. I want to sell this banker's acceptance, okay, from the Kenyan bank, okay. You can sell, for example, okay, in T-Note today, okay, you can say, I'll sell this for, let's say, 950,000, okay. So you don't have to until the end of month 3 to get your money. You can just go to the market, trade on that particular banker's acceptance. Okay. So the one who's going to buy is one who's going to wait until the month of October, for example, and receive the $1 million upon Bank ABC transferring, okay, to the X Bank in China. Okay, the referred to as the banker's acceptance. Okay. So that acceptance, that commitment, okay, commitment letter, somebody referred to as actually commitment letter, okay, is a tradable instrument, okay. So you as this company, you may not have to wait, okay, until it matures in 3 months' time. They call a banker's acceptance, okay. Clear? Okay. Silence means that you agree, I propose. Okay, so let's do a question here. Okay, so there's a question here I would want us to do. Okay, so go through this, then give me the answer in this example. What do you get to be the repurchase price? Lillian?
Yes, I'm getting 10,134,794.52.
Okay, yes, that's the last answer. Thank you, Lillian. Don't forget, in this case, the rate that you're going to be given, okay, this rate here is per annum, okay? It is not going to be serious in most of the time, okay? However, the repurchase rate is always per annum basis, okay? That was a trick, okay? That was the simplest trick. Because therefore, the repurchase price, okay, therefore, is equal to 10 million, okay, plus the interest. In this case, the interest will be equal to 0.082, okay, times 60 days out of 365, okay, times the 10 million, okay, and that therefore is going to give therefore, okay, 10,134,000, and what do you get?
794.5.
795.
Yeah.
Okay, 795. Okay, and that comes for the repurchase price. Okay, 10,104,695. Okay, that's the repurchase price. Okay, so the trick here is to ensure to always know that the repurchase price essentially will be per annum. Okay. Generally, I don't expect examiner to bring it to you to the main exam to do some of this calculation. Okay. However, just in case they are brought, I guess you know how to go around it. Okay. Now that was the money market. Okay. In the case of capital markets, as we mentioned, we have said that in the case of the capital market, this is where now we have those financial instruments or the trading of those financial instruments where they have a life of more than one financial year. Okay. And of course, the two main instruments tradable in the capital markets are equity, and we have equity and the bonds. Okay, so those are again the two main financial instruments that are tradable in the capital markets. The equities, that is equity shares, okay, and you have the corporate bonds. Okay, so those are the two main financial instruments. Okay, we can further classify. Okay, that was the first classification: money market and capital market. We can further classify the financial market, okay, stock market, into two main categories. Okay. We have the primary market and here we call the secondary market, primary versus secondary market. Now, what is the difference between primary and secondary market? Okay. The key distinction is how is this transaction occurring? Okay. If the financial instrument, if the security, okay, is being issued for the first time ever, okay. Let me actually go back to my board to explain it further. If, for example, we have here the surplus unit. Okay, let me call them lenders. Okay, I think that's a better term for now. So we have lenders and you have here the borrowers. Okay, so we're going to have here the flow of capital. In return, there's going to be the contract or the security. This is security. This is the flow of capital or funds. If we have that case where the transaction is occurring for the first time ever, okay, so the borrower goes to the market and issues an instrument and issues a security, okay, and the lenders, the investors, okay, we call them investors, okay, they do pay, okay, or they do pay the borrower, okay, to acquire those securities, okay. So we can see this transaction, okay, or the flow of capital, the flow of money is from the lenders to the borrowers directly, okay, from the lenders to the borrowers directly, okay. Then that transaction, okay, that transaction is occurring in the primary market, okay. This is occurring in the primary market. Because why? Because this security is being offered for the first time ever by the borrower to the investors, to the lenders in the market to obtain the capital, okay. That's called the primary market. In the subsequent, assuming that this transaction occurred, let's say in the year 2010, okay. Now we are in the year 2020. if I'm an investor and I want to buy the shares of, let's say, this company A, okay, I want to buy the shares of company A, okay. However, those shares were issued in the year 2010, okay, and I want to buy the shares now in year 2020. Now, how can I go to buy those shares, okay? If you have to go to the stock market, those shares, don't forget, they are tradable, okay? The shares of company are tradable, okay? So you have to look for who is selling the shares of this company, okay? Who is selling the shares of this company, okay? And still you're going to get an investor in company who want to sell them off, okay? So you have here, let me call this investor B, okay? So this was investor A, okay? Now we have here investor B, they want to buy the shares from this investor, so investor B, okay? Don't forget the investor A bought the shares in year 2010, okay? Investor B want to buy the share in year 2020, okay? So he can't go to the company to buy the shares. So he has to look for someone else to buy the shares when they're being issued, okay? So he's going to go to investor A, okay? Give investor A the capital, okay? The selling price of that particular share upon which they do agree, okay? So that's going to be the capital, and of course, investor A is going to give the security, is going to sell security to investor B, okay? So you show therefore the flow of capital, okay, if is from one investor to another investor, okay? So the company here, there's no company here, okay? There's no flow of money here, okay? The money is flowing from, okay, investor A to investor B. Okay, so it's subsequent, okay, the company is not going to be a participant in short, in this transaction. Not like in here, the prime market where the money was flowing from investor A to the company, okay? But in this context, okay, the company is not going to partake of the transfer of funds, okay? And it's therefore, you see this transaction is occurring in the secondary market. So the transaction is occurring in referred to as the secondary market. The trading of the subsequent, the trading of the subsequent trading, okay, the selling and the buying of the financial instruments after they have been issued. The transaction occur in the secondary market section of the stock market, okay, or the financial market, okay. A key distinction between the two, the primary market and the secondary market, okay. Now the key question therefore remains, okay. Yes, it's true. We can see that we can be able to understand why we do need the prime market, because of course company need to finance themselves, okay, through the issue of the financial instrument, okay, the bonds as well as the new shares, okay. But why do we need the secondary market, okay? There are a number of reasons, okay, why the economy, okay, does need the secondary market, okay. One of them is the element of diversification, okay. Now, if, for example, okay, an investor, you bought the shares of this company in year 2010, okay, when maybe you had multiple income sources, okay, by then you had other income sources. So therefore, the dividends, for example, okay, the interest from the bonds, okay, they were not very supplemental income, okay, to your homestead, okay. However, seeing that you have, in quote, lost the job, okay, now you cannot invest in high risk investment, okay. You can't, for example, invest in, you may, but not as the current status. You can invest in equity share. Why? Because equity shares are quite risky. So what do? As an investor, you may want to say, I want now to invest in bonds, okay. I want to invest in bonds, okay. Bonds are going to give me, in quote, an assured return, because the interest is fixed, okay. For the case of equity, don't forget the interest, the dividend is not a guarantee, okay. However, for bonds, the interest is a guarantee. That, for example, every 6 months, you're getting X shillings from your investment, okay. So therefore, in that case, therefore, you may want to diversify your portfolio, diversify your investment, okay. But for example, having more of bonds, okay, as opposed to having more of equity, okay. You want to introduce more assets, okay. If, for example, you're an investor, you bought the shares of Safaricom, okay, in 2008, okay, and now you want to add more shares in your stock, okay, and currently there is no new issue that is happening. How can that happen? You have to go to the secondary market and try to acquire the shares you want, okay, from other investors who bought the shares when they're being issued, okay. So you want to increase, for example, the range of assets. You want to increase the range of assets, the asset in terms of the number in your investment, and also the range of assets within your portfolio. Okay, that can only happen in case there's an operational secondary market. The element of risk shifting, okay, I think I've already discussed indirectly the element of risk shifting. Okay, is for example, okay, you do consider yourself as less risk a risk. In case you do consider yourself as more of risk taker, okay, you're willing to take more risk, okay. Then of course, generally you do take up those risky assets, okay. We're going to mention later on one of theory that says that if you're going to assume high risk, then generally the investment ought to yield high returns, okay. Anyway. If currently you are willing and able, okay, to assume the risk, okay, then it is better you invest in those risky assets, okay, because they yield high returns, okay. But as time goes by, as you become older, okay, then most of the time you don't want to assume risk. Therefore, you may want to shed off those assets that are more risky. You may want to decrease, therefore, equity, and you buy more of bonds, okay? In short, therefore, you're willing to shift the risk, okay, from being a high risk investment, okay, to a low risk investment, okay? You can only be able to shed off those risky investment through the secondary market, okay? Then you have the element of hedging, okay, which we will not discuss in this syllabus. We discuss in the advanced financial management, okay. But one of the new instruments that I think I was mentioning that for example, the NSC want to offer, I'm not sure, I don't have the news whether it is still operational, okay, whether it is operational, okay. We have what called the futures, okay. Now, futures are actually money market instruments, okay. Futures are actually money market instruments, okay. And there's a contract, for example, between the exchange, in this case, the NSC, okay, and the person who want to hedge on their risk, okay. One of the risks they may want to hedge is what referred to as the foreign currency risk, okay, the foreign currency risk. And so that you're a farmer, okay, and you've made a sale of tea, okay, to Europe, okay. You're a farmer, you've made a sale of tea to Europe, okay. The customer in Europe, okay, is going to pay you in, let's say, 3 months' time, okay. So you're going to get money in 3 months' time. How much? Let's say 1 million euro, okay. Don't forget, you don't trade in euros. You are Kenyan. You are a Kenyan company. You are a Kenyan farmer. Okay, so therefore you must convert the receipt, okay, from euros back to shilling. Okay. And for example, let me just have my board. Okay. Okay. So here you are a farmer. You make a sale. Okay. Today T note. Okay. The sale is 1 million euro. Okay. You're going to receive money in 3 months' time in T3. Okay. So here in your books, okay, in today's term, of course, you want to know, okay, how much money will I be getting in 3 months' time, okay? So you go to the spot, you go to, we call it the spot market, okay? You go to the market. What's the current price of 1 euro, okay? Is let's say 110, okay? So 110 shilling per euro, okay? So the imply, therefore, once we convert, this money is converted in Kenyan shilling, therefore it's going to be equal to 110 million Kenyan shilling, okay? That is what you anticipate. This is what you expect to receive in 3 months' time. However, assume that in 3 months' time, the Kenyan shilling is stronger. Okay, so to buy 1 euro, okay, you'll be paying less. You'll pay, for example, 98. Okay, to get 1 euro, you'll be paying 98 Kenyan shilling to get the 1 euro. Okay, which implies that for in 3 months' time, okay, you'll be receiving 1 million euro. But in case you exceed, then multiply by 98, it means you'll be getting 98 million Kenyan shilling. Versus what you are anticipating to get, which is 110. You can see here you have made a loss here. Okay, you have made what we call a foreign currency exchange loss of 12 million. Okay, now you as an investor, you may want to decide. Okay, I don't want to be exposed to this risk. Okay, I don't want to be exposed to this risk. Don't forget you're still in T note. Okay, so what can you do? You can enter into contracts. Okay, you can go to the floor of NSC. Okay, and buy what we call a futures contract. Okay, futures contract. Okay. Where the NSC is telling you that we are going to agree. We are going to agree on a rate we shall be applying in future. Okay, so you can see here right now it's 110. We as NSC, you're going to in quote like buy your 1 million euro. Okay, at 1 shilling, 1 euro. You're going to buy, for example, for let's say 105, okay, 105 shillings per euro, okay, 105 shillings per euro, okay. So since you enter the contract today in T notes, okay, of course in your book you don't recognize 110, you recognize the 105 million. In 3 months' time, it doesn't matter what is going to be the rate then, okay, because already you have a contract with NSC. So therefore you'll be receiving in 3 months' time, deliver your 1 million euro, okay, in exchange the NSC is going to give you the 105 million shilling, okay. So therefore you can see there's no difference from what you are expecting versus what you're going to actually receive at the end of the day, okay. Now this is one of the instruments that can be used in the stock market, okay, the use of the futures contracts, okay. They're tradable, okay. So in case maybe in 2 months' time, okay, then 2 months later, there's T naught, there's T3. So in 2 months, if 2 months later, okay, you think the cash is coming weaker, therefore, if for example the cash moves from this right here, okay, move from 110 to let's say 112, then you can gain if you have to go to the market, you ignore the contract, okay. In short, therefore, you ignore the contract because the contract you're going to get 105 million. But in case you go to the market, you're going to get 112 million, okay? If you can decide to, why don't I just go to the market and sell off this contract I entered with NSC, okay? So you can decide to do that, okay? So this contract you did enter with the NSC here, okay? It is tradable in the market. So you can decide to trade on it, okay? So you don't say that this is actually a money market instrument, okay? So for now, don't worry about the math, okay? Just know what is called a futures contract. Okay, you can use it to reduce the risk, to hedge on your risk. Okay, one of the risks is the foreign currency risk. Okay, so in advanced financial management, we will discuss the hedging as a technique. The other function that normally the secondary market do play is what called the arbitrage. Okay, what is arbitrage? An arbitrage is a chance. Is you as the investor, you can be able to spot what called a market mispricing. Okay, you can spot what referred to as a market mispricing. Okay, where if, for example, the shares of one company are mispriced, okay, their current value in the market for the MPS, the market price per share, for example, is, let's say 20 shilling. Okay, however, you have out of your analysis, I don't know, you have information, for example, okay, that the price of this share is not 20, but the price is, let's say, the value is 25. Now, what would you want to do there, by the way? If, for example, the true value is 25, however, the market is giving the value of that particular equity share for 20. If you are an investor, what would you want to do there? What action would you take? Yes. No, we can't all be blank for sure. Yes, Lillian.
Yeah, you buy it at 20, then sell it at 25.
Yeah, that's what can you do. That you can buy it at 20 because there's a market mispricing. Okay, you buy the share at 20 with the hope. Okay, this is not always a guarantee that the price is going to go back to 25. But if the market is quite liquid, okay, the market is quite deep, then it is possible the price ought to go back to 25. It's true price. Okay, so of course you can buy at 20, wait until the share price go back to 25. But that essentially is not referred to as arbitrage. Arbitrage is a scenario where, of course, you're going to make a profit. But don't forget here you bought the share. You're going to make a profit of 5 shillings per share. Okay, but that's not arbitrage. Okay, arbitrage, you don't need to buy that share. Okay, what you can do is you can enter into contracts. Enter into contracts. Okay, agree. For example, okay, I'm going to buy your share maybe tomorrow. Okay. You enter a contract where you're going to be purchasing the share at let's say 20.5, for example. If by the end of the day tomorrow, okay, the share price has now what you can do, okay, first you enter into a buying contract, okay, then try to get a counterparty who is going to be buying from you, okay, someone who is going to buy from you, okay, for example, get an agreement that they're going to purchase, okay, from you a share tomorrow, okay, for let's say a price of let's say 24.5. or even 23, okay? Assume that's 23, okay? Unless we're at 23.5, okay? So here you have two contracts, one to buy and one to sell, okay? So tomorrow, okay, the person you're going to enter, don't forget here tomorrow, you're going to get this share, 20.5, okay? Then come and sell it to this person 23.5, okay? In short, the funds you're going to obtain from here is what you're going to pay off the initial contract here. Okay? In this case, you don't actually need to buy that share, okay? Or you can have it enter into contracts, okay, with a number of participants in the market, okay? Now, in that case, if you have zero investment, only the contracts you have in place, then they call arbitrage profit, okay? Don't forget that's only going to happen in case we have an operational secondary market, okay? If not, then this transaction cannot occur, okay? And these are some of the functions of some. They're quite many, okay? But some of the functions that the secondary market do play in an economy, okay? All clear? Someone has a question? Okay, so that's on how the financial market and financial institutions, what are the functions, okay, and the different securities that can be operated in each one of them. The financial market, as well as in the case of the financial institution. As I mentioned, don't worry about in math here, okay? So the calculations here, they are beyond the scope, okay? But just get to know there's discussion regarding the different type of markets, capital markets, money market, different securities, equity bonds, okay, commercial papers, T-bills, T-bonds, okay, so CDs, so all those you should be able to discuss them very well, okay. Now, we can set the market to refer to as the international money market, okay? But the key difference here between the money market and the international money market is simply where the transaction occurring, okay? Are they beyond the domestic market? If the transaction is occurring beyond the domestic market, then we say it's occurring in either the international money market or the international capital markets, okay? If the transaction is occurring, if the instrument that is being offered, okay, in the international money market, okay, that means try to bring it home, okay. So if, for example, a Kenyan company, let's say EABL, okay, they want to issue shares in Tanzania, okay, EABL want to issue shares in Tanzania, okay, they issue these shares in Tanzania shilling, okay. Then we see that they're issuing equity, okay, beyond their domestic market, beyond Kenya, okay. Therefore, that transaction is occurring in the international capital market, okay. If the Kenyan government, okay, goes to the US market and offers bonds, okay, they want to issue treasury bonds, okay, to the US market, okay. Therefore, we can say the transaction is occurring in the international capital market, okay. So it's not something to worry too much about, okay. But either way, okay, it's simply where is the transaction occurring, domestic market or the international market, okay. Generally, okay, when we have referred to as the money market transaction occurring in the international market, okay, then we normally refer to them as the euro currency markets, okay, that's another term, okay. Then in case there are bonds that are being issued in the international money market, then it's called the euro bonds. If they are equity, they're called this term for sure. I think you've heard it before for quite some time. The euro bonds, okay. An example: Kenyan government goes to the U.S. market and issues bonds. Okay, so the buyers, the issue is the Kenyan government. The buyers are the public members, firms in the U.S. market. So they issue it, for example, in dollars. Okay, of course they don't go to issue in Kenyan shilling. Okay, they issue them in dollars. So those are euro bonds. Okay, that are being issued by the Kenyan government in the international market. Now, if there are equity shares, like the example I just given, EABL goes to the Tanzania market and issues the shares in Tanzania shilling. Now, what do we refer to those equity shares? They're called from what just stand here. Euro bonds is again to be bonds issued in the international market. Okay, By the way, the term euro doesn't mean that it has to be in euros. It can be in the currency other than the currency of the issuer. In this case, if it's issued in the South African rand, okay, that's in itself is a euro bond. Okay, so what qualifies a bond to be a euro bond is simply is the issuer issuing a different currency other than his home country currency. Okay, Sharon, what do you think they are equities? If they are equities, what do you refer to them? Sharon, you had your hands up.
Okay. If you've said if now the Kenyan market, the Kenyan company is issuing bond in the East African, like Tanzania.
These are euro bonds. What about equity?
I think it's Kenyan company issuing to a Kenyan company.
A Kenyan company, a Kenyan company, EABL, they go to Tanzania market, they issue their shares not in Kenya shilling, but in Tanzania shilling. Now those are equity, okay, that are being issued in the international market, okay. Now, in that case, therefore, what term do we use for those equity? That's the question. What term do we use for those equities? If bonds are called euro bonds, what about equity?
No idea.
Just from that point of view, okay, that bonds are called euro bonds. What about equity?
Equity bonds.
Sorry?
Equity bonds.
Equity bonds. A good guess. Okay, equity bonds. But now the term bonds there is one that is making it not to be very true. Well, these are equity shares. They're not debt instruments. These are equity shares. I agree that you have an idea, but the term bonds there has made the answer wrong. What's the term that is used to refer to those equity?
Euro equity.
Yes, they're called euro equity. Yes, they're called euro equities. Thank you. They're called euro equities. Thank you for that. They're called euro equity. So as I mentioned, the term euro doesn't mean that this is the currency. It will mean that this particular equity was issued in a currency other than the currency of the issuer. In EABL, the currency of the issuer is the Kenyan shilling. So in case they go ahead and issue a bond in other currency other than the Kenyan shilling, then this is a euro equity they are issuing. Okay. Okay, so maybe I just want to introduce some of these terms, so just in case your examiner decide to test them. Okay, of course there are more towards what we have mentioned, but I just want to make a mention. So in case you want to do more analysis or research, feel free. Okay. So the concept I want to mention here is the rate of return and the interest rate. Okay, the rate of return and the interest rate. Okay. Then don't forget what is the price of money. Price of money is the interest rate. Okay, the price of money is the interest rate. Okay, so that's a simple definition of interest rate. It's the price for money, the price of money. Okay. And of course, in case you're going to be a borrower, of course, you do need to make a payment to the lender. Of course, a certain percent of the capital that they gave you. Okay, the return that you're going to promise to the lender, to the investor. To the investor, it's a return. Okay, to you as the issuer, the person who borrowed money. Okay, don't forget this is a cost to you. Okay, in some later topic, we shall be discussing how we do get the cost of capital. To you as the issuer is a cost. To the investor is a return. Okay, so it's worth enough to take that note. So generally, okay, what are some of the factors that do influence the interest rate, okay, between the borrowing and the deposits, okay? The return that the depositors shall be receiving and the return that the lenders do charge to their money. In case you make a deposit in Equity Bank, a fixed deposit, of course, they're going to guarantee you a certain return, okay? But of course, in case you're going to borrow, of course, the Equity Bank is going to charge you, of course, by default, higher interest rates than what they gave you on your fixed deposit. Okay. Now, what influence therefore that margin? Okay. Of course, one of the key factor is on the demand and supply. That's one of the key factor, okay, that do influence that margin, okay. The demand and supply, okay. How many people are willing to deposit the money, okay? If there are few depositors, then you have to entice them, okay, by giving them a higher interest rate. If the depositors are many, then definitely most often than not, the bank are going to give a very low interest rate to the depositors, okay, compared to what they're going to be charging to the borrowers, okay. But you have other factors, okay. You have some other factors. Of course, another factor is on the risk, okay. Another factor is on the risk. If you're going to be the borrower, okay, and you're a risky borrower, of course, the bank is going to charge you a quite high interest rate, okay. What is your risk, okay? If you're going to be a high risk investor, then of course, we are going to be charging you higher interest rates. Then you have the need for profit, because in most cases, okay, of course, the major portion of the company, the bank profit is going to be the interest rate, okay? So the interest rate, the interest income, okay, the interest income. The expense is the one of the major expense is not major expense, but one of the expense that you will be having is the interest expense. Okay, so in case the bank has a need for very high profit, okay, the difference of course is going to give us there for the profit. If the need for profit is going to be higher, they can try to see how can we minimize our expenses. Is one of the ways by giving a very minimal fixed deposit rate. Okay, and for most bank, I don't know whether I think they normally give 4%. Okay, I don't know. It depends which bank that we're dealing with. Okay, but they give a very low return of 4%. If you go to borrow, some bank will charge you all the way to even 30%. Before, I know those days before the law was passed, okay, the one for the interest rate cap, okay, some bank will charge even as high as 30% per annum. Very high, okay. Anyway, so of course the need for profit is going to be one of the drivers that is going to dictate how much interest they give you as a depositor and how much they do charge to their borrowers, okay. And you also have the duration for lending, okay, duration for lending money, okay. So let me ask you a question. If, for example, all factors remain constant and the only difference between these two borrowers, okay, is on the duration. Okay, one borrower A, okay, borrows money for 10 years. Borrower B borrows money for 5 months. Now, among these two borrowers, we assume they have all the factors are the same. All their risk exposure, in terms of the age. So all the other factors are the same about these two borrowers, except that one is going to borrow for 10 years and the other is going to borrow for 5 months. Where do you think the bank is going to charge or should charge a higher interest rate? A or B? Akutu.
B.
B. Why B, Akutu?
Because it has fewer months.
Okay, let me ask you. Let me bring this into. Let me try to bring it home. If I'm going to borrow from you money for 1 week, and I'm going to borrow money from you for 2 years, where are you going to be reluctant to give me your money? 1 week or 2 years?
2 years.
2 years.
2 years. Okay. So based on that, which one is more expensive? Therefore, A or B?
A.
A is going to be more expensive, definitely. A is going to be more expensive, okay? Why? Because also called illiquidity, okay? What we refer to as the element of illiquidity. That in case we have, where you as an investor, you're going to give your money for a long period of time, you're going to be requiring more premiums, okay? Because in this case, for A, he's going to give his money and wait 10 years to get the money back. For B, he's going to get money in 5 years' time. So definitely for A, he's going to be requiring more premiums, okay? Because his money is going to be tied down in an investment for a longer period of time, okay? The next factor is the size of the loan, okay? The size of the loan, okay? Size of the loan, okay? So we have A here, we have B, okay? So A is going to borrow from the bank $10 million. B is going to borrow from the bank, let's say $100,000. Assume that all factors are the same for A and B, and the only distinction between A and B is on the amount they're borrowing. Now, where do you think there's going to be more, where the bank is going to charge higher interest? Is it A or is it B? In case you're the bank, you're the one who's lending out this money. Where would you charge more? And your main business is lending out money. Joseph,
A.
A, you can charge more interest in A.
Yes.
Why?
Because this guy will take a lot of time. Will take a lot of time with my money.
No, time is the same. No, time is the same. Let me actually classify. All the other factors are the same, except the amount of money they are borrowing from you. So the time is equal. Just would you want to rephrase your answer?
Okay, he will be holding a lot of my money, so I'll charge him more for using a lot of my money.
No, so you charge more A because they have more of your capital.
Yes.
Okay. Sharon Otayo. Sharon? You're too far from your mic.
I think it's A
You think
because,
it's A?
okay, assume the interest rate is around 5%.
Mm.
Okay, 5% of A than 5% of B.
So I didn't get the argument. So where do you charge more interest, A or B?
A.
You're going to charge more interest in A.
Yeah.
No, look at the percent. Don't look at the actual pay that this person is going to pay. The percent. What rates? Where do you charge more interest rates? A or B?
A.
A. Okay. Someone else will have an idea. Now let me ask, what is the core business of the bank? Is to lend out money. Okay, of course they have some other function they do play. Okay, but if you look at the classic bank, what is their key role? Is about trying to get a deposit and lending out money. Which imply, therefore, if let's take the case from the in quote the known to the unknown. If you are a wholesaler, okay, you do make sales, okay, you are company manufacturers. We have a customer coming to buy from you goods worth $10 million. And a customer who's going to come to buy from you goods worth $100,000. Where do you give more discounts? A or B?
A.
You're going to give more discounts in A. Then why do you have some separate? Why would you therefore, as a bank, charge more interest in A? And A is borrowing more money from you. He's giving you more business. So generally, what is going to happen that the bank is going to charge lower interest rates to A compared to B. Because a simple example, for the bank in scenario B, let me put this called scenario B, okay? For the bank to be able to lend 10 million, they do require 100. They require 100 different customers to take 100,000 for the bank to get to the 10 million. Don't forget all these costs you incur. Don't forget, as a bank, you do incur the cost of processing those loans. So the cost you incur here is going to be, if the cost per loan possession, okay, processed loan is going to, for example, $1,000. It means therefore in A you're going to incur $1,000. In B per issue you're going to incur $1,000. Okay, so $1,000 cost per transaction times 100. You can see. So here you're going to end up with having very high cost of administering or even processing these loans. So by default, therefore, you're going to give part A more discount in quotes. They're going to be charging lower interest in scenario A compared to scenario B. Okay, hope it's clear. Don't forget, the main business of the bank is to lend money. Okay, I think that's what you need to get to the back of your mind. The business is about lend money. Okay. Anyway, so the next thing here is on the type of financial instrument, the type of financial asset. If, for example, you have called as a secured, because secured loan here. and you have the unsecured loans. Okay, they're both loans, even the same, except one is secured, the other is unsecured. Where do you think the interest charged by the bank is high? The secured or the unsecured? So you have two loans here. It will be an issue by the yes, same someone here. Sharon Candy.
I think the unsecured loan.
So unsecured, there's more interest to be charged.
Yes.
Yes, it's the unsecured, there's more interest that the bank is going to charge. Why? Because it has more risk exposure. Okay, that in case this person fails to pay me my money, default, okay, then I don't have an asset, I don't have a collateral, I don't have a security, okay, upon which I can dispose and repay myself. Okay, so therefore the risk is going to be high. Of course, therefore the interest to be charged here is a bit high. The more the risk, okay, the more the risk, of course, therefore the more is going to be the interest that the issuer, the bank is going to be charging the borrower. Okay. Then I mentioned, okay, so all those factors are clear. I mentioned that generally, when it comes to the investment, okay, that investors, okay, you have to consider the risks that you are exposing yourself to, okay, the risk exposure. Because in case you're going to be, generally, we do say that when it comes to investment that you're going to have a high risk exposure, okay, a high risk exposure, therefore we anticipate, okay, that we do expect to get more returns. If that's not the case, therefore, why would you want to invest in that particular asset? Okay, so high risk assets must be yielding high returns. Okay, that is in the assumption of the convention of finance. Okay, that the high risk assets must yield high returns. If you don't want to assume the risk, then definitely you as an investor, you must be willing to accept the low returns. Okay, because a low risk asset conventionally do bring low returns. Okay, so there will be a risk return trade-off. Okay, you either take the high risk, in case you want the high return, then you must be willing to assume the high risk. If you want to assume the low risk investment, then those investments will bring to you low returns. Okay, that's as simple as per the dictate of the risk return trade-off theory. Okay, so you as investor, you have to weigh, okay, how much return do I want to receive? And by deal, therefore, you must also be matching it against the return that you come with. Okay, if you want high returns, then you must be willing to assume, therefore, the high risk. Otherwise, if you don't want to expose yourself to risk, okay, then that means therefore you are willing to accept the low returns. Okay, that is referred to as the risk return trade-off theory. Okay. However, that does not always. That's sometimes, okay. Sometimes that is not always going to be the case. Okay, we have cases where the low risk are. Sorry, I lost my internet here. Anyway, you can have cases, okay, where we have the assets, okay, that yield high. Assets that have low risk, sometimes they may yield high returns, okay, which is not the conventional finance, okay, where you have assets low risk assets giving high returns, but it can happen, okay, it can happen, okay, where for example bonds, okay, they give higher returns than equity, okay, because generally assume that in finance theory is that equity are more expensive than debt, okay, which imply therefore we anticipate therefore that equity ought to give therefore high returns. But you can have cases where equity give returns lower than the return received if you have to invest in debt instrument, if you have to invest in bonds, okay. That will refer to as a reverse yield gap, okay. So refer to as a reverse yield gap, okay. Reverse yield gap, okay. It doesn't happen that often, okay. It doesn't happen that often, but it can happen, okay. A scenario of reverse yield gap. Okay. Now, when it comes to the ranking of the investment, if you have to rank the investment, okay, from the one that has high returns to one that have low returns, okay, Of course, we have government bills. Okay, we have the case of the T-bonds, for example. Okay, having the lower returns. Why? Because they have low. They have the risk exposure. The risk exposure to the investor is a bit low. Okay, so you have for investments that again be having low return. They give low returns because they have low risk exposure to the investors. Okay. And of course, you have a case of the corporate bonds. Okay, of course, they have an element of risk with them. Okay, however, it's not going to be always going to be the case where they do expose the investor to high risk. Okay, so therefore, in this case, therefore, corporate bonds. Okay, they have low returns. Okay, higher than the T-bills, higher than the T-bonds. However, they do have lower returns than the case of, for example, equity shares and the private shares. Now, the case of private shares, they're going to be in between the bonds and the equity shares. Why? Because private shares have an element of equity with them and an element of debt with them. Okay, that's for the case of private share. Okay, they have a debt and they do have an equity element. Okay, why debt? Because private share pay fixed dividend. They pay fixed dividend. Why equity? Because don't forget here they are irredeemable. Conventionally, they are irredeemable. They don't have an end life. Okay, so they behave like debt. Okay, so that's why the equity private share, even their risk is in between the bonds and equity shares. So it is in between. Okay. And that's what I had for you. Okay. So this is just a summary of what we are going through under the money market instruments, okay, for that particular topic. Okay, question? Yes, there's someone here with a question. Sharon, you have a question?
Yeah, okay. I'd like you to repeat on the difference, the bonds, like the company, the government here. I didn't get that clear.
Okay. Now, it's not necessary that government issued securities. Government issued security. For example, the question, let me ask you, Sharon, can the government default on paying?
Sorry?
Can a government default on paying on its obligations?
Kenyan government does, but it's not supposed to.
Generally, for most governments, even most governments, they don't default or they should not default on paying. Okay, so rarely does that. In the worst case scenario, okay, some government goes to an extent of printing money to pay off the obligations. Okay, of course, it has the effect of inflation, but in the worst case scenario, they can do that. Okay, so conventional norms that the government will always fulfill its obligation. So which implies that for you as an investor in the government bonds, okay, you have very minimal risk. Okay, you have very minimal risk. Okay, which implies that for the return you all be receiving is going to be low. Okay. Now, in case we take the case of company bonds, don't forget, company can default, not even default, company can close down the shop, okay, which can't happen in the case of the government, okay. Therefore, their risk is a bit higher than the government bonds. However, their risk is not that high more than the case of equity. Clear?
Yeah, it's clear now.
Okay, fair enough. That now is 7:24. So, Joseph. Joseph?
Yes, sir.
So we can take a break.
Yes, please.
We meet our time. Right now is 7:25.
How about 10 minutes break?
So we meet at 7:05.
Yeah.
Okay, fair enough. Let's meet at 7:05.